I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The Treasury Bond Basis by Galen Burghardt is a must-read book for anyone interested in understanding the intricacies of the bond market, specifically U.S. Treasury bonds. The book is a comprehensive guide to the mechanics of the bond market, including the relationship between yields, prices, and interest rates, and the factors that influence them. Burghardt begins by explaining the concept of the basis, which is the difference between the futures price and the spot price of a treasury bond. He then goes on to explore the various factors that affect the basis, including interest rates, delivery options, and the characteristics of the underlying bond. Throughout the book, Burghardt uses real-world examples and case studies to illustrate the concepts he is discussing. He also includes a number of helpful diagrams and charts to aid in understanding the material. One of the most valuable aspects of the Treasury Bond Basis is Burghardt's discussion of trading strategies. He provides detailed explanations of various trading strategies, such as basis trading, cash and carry trading, and the repo market, and offers insights into how traders can profit from these strategies. Despite the complex subject matter, Burghardt writes in a clear and engaging style that is accessible to both novice and experienced traders. He has a talent for breaking down complex concepts into understandable pieces and providing practical examples of how they work in the real world. Overall, the Treasury Bond Basis is an excellent resource for anyone looking to deepen their understanding of the bond market, especially U.S. Treasury bonds. It is an essential read for traders, investors, and anyone who wants to be more knowledgeable about the workings of the financial markets. In the book, The Treasury Bond Basis, Galen Burghardt explains that the basis is the difference between the futures price and the spot price of a treasury bond. Futures contracts are agreements to buy or sell an underlying asset at a predetermined price and time in the future. The spot price, on the other hand, is the current market price of the asset. In the case of treasury bonds, futures contracts are available for delivery of specific treasury bonds on a future date. The price of a futures contract is based on the expected future price of the underlying bond. The basis is the difference between the futures price and the spot price of the bond. There are several factors that can affect the basis. For example, interest rates can have a significant impact on the basis. If interest rates rise, the yield on the bond will increase, which can cause the futures price to decrease, leading to a wider basis. Conversely, if interest rates fall, the yield on the bond will decrease, which can cause the futures price to increase, leading to a narrower basis. Another factor that can affect the basis is delivery options. Treasury bond futures contracts have various delivery options, including the cheapest to deliver option, which is the treasury bond that is the least expensive to deliver on the settlement date. If the cheapest to deliver bond becomes more expensive relative to other bonds, the basis can widen. The characteristics of the underlying bond can also affect the basis. For example, the maturity of the bond and the coupon rate can impact the basis. Bonds with longer maturities or higher coupon rates may be more attractive to investors, which can cause the futures price to increase, leading to a narrower basis. Overall, understanding the basis is essential for successful trading in the treasury bond market. By considering the various factors that can affect the basis, traders can develop strategies to profit from the market's movements. In the Treasury Bond Basis, Galen Burghardt explains that the basis is affected by various factors, including interest rates, delivery options, and the characteristics of the underlying bond. Interest rates are a critical factor in determining the basis. The yield on a treasury bond is a function of the bond's price and coupon rate. As interest rates change, the yield on the bond will adjust, causing the price of the bond to fluctuate. This, in turn, affects the futures price and the basis. A rise in interest rates will cause the yield on the bond to increase, which will cause the price of the bond to decrease. This will, in turn, cause the futures price to decrease, leading to a wider basis. Conversely, a decrease in interest rates will cause the yield on the bond to decrease, which will cause the price of the bond to increase. This will, in turn, cause the futures price to increase, leading to a narrower basis. Delivery options are another important factor in determining the basis. Treasury bond futures contracts offer different delivery options, including the cheapest to deliver option. The cheapest to deliver option is the Treasury bond that is the least expensive to deliver on the settlement date. If the price of the cheapest to deliver bond increases relative to the other bonds, the basis can widen. The characteristics of the underlying bond can also affect the basis. For example, the maturity of the bond can impact the basis. Bonds with longer maturities may have a wider basis due to greater uncertainty about future interest rates. The coupon rate can also impact the basis. Bonds with higher coupon rates may be more attractive to investors, causing the futures price to increase and the basis to narrow. Other factors that can affect the basis include supply and demand imbalances, changes in market expectations, and geopolitical events. Overall, understanding the factors that affect the basis is essential for successful trading in the Treasury bond market. By considering these factors, traders can develop strategies to profit from the market's movements. In the Treasury bond basis, Galen Burghardt emphasizes the importance of Treasury bonds in the fixed income market and how they are widely used for investment and trading purposes. Treasury bonds are debt securities issued by the U.S. government, and they have a fixed interest rate and a specified maturity date. They are considered one of the safest investments in the world, as the U.S. government has never defaulted on its debt. This makes Treasury bonds attractive to investors who are looking for a safe haven asset. Treasury bonds are also highly liquid, which means they can be easily bought and sold in the market. They are traded on exchanges such as the Chicago Board of Trade and the New York Mercantile Exchange, and are also available through electronic trading platforms. This makes it easy for investors and traders to access the fixed income market and take positions in Treasury bonds. Moreover, Treasury bonds play a significant role in the financial markets, as they serve as a benchmark for other fixed income securities. This means that the yield on Treasury bonds can influence the interest rates on other debt instruments, such as corporate bonds and mortgage-backed securities. Given their liquidity, safety, and benchmark status, Treasury bonds are widely used for investment and trading purposes. Investors can use Treasury bonds to diversify their portfolio and hedge against market risks. Traders can use Treasury bonds to speculate on interest rate movements and profit from changes in the basis. In summary, Treasury bonds are a critical component of the fixed income market, and their liquidity, safety, and benchmark status make them attractive to investors and traders alike. By understanding the characteristics of Treasury bonds and the factors that influence their prices, investors and traders can make informed decisions about how to incorporate these securities into their portfolios and trading strategies. In the Treasury bond basis, Galen Burghardt emphasizes the importance of understanding the relationship between yields, prices, and interest rates when trading Treasury bonds. The yield on a Treasury bond is the return that an investor receives on their investment. The yield is determined by the bond's price and coupon rate, with higher prices resulting in lower yields, and vice versa. For example, if the price of a Treasury bond is $1,000, and the coupon rate is 2%, the yield would be 2%, $20 per year. If the price of the bond rises to $1,100, the yield would decrease to 1.82%, $20, $100. Interest rates are another critical factor that affects the yield on a Treasury bond. As interest rates rise, the yield on a bond must increase to remain competitive with other investments. Conversely, as interest rates fall, the yield on a bond can decrease, making it more attractive to investors. The relationship between yields and prices is important to understand when trading Treasury bonds. When interest rates rise, the price of a bond will decrease, causing the yield to increase. This is because new bonds issued at the higher interest rate will offer a higher yield than existing bonds, making the existing bonds less attractive. Conversely, when interest rates fall, the price of a bond will increase, causing the yield to decrease. This is because new bonds issued at the lower interest rate will offer a lower yield than existing bonds, making the existing bonds more attractive. Understanding the relationship between yields, prices, and interest rates is essential for successful trading in the Treasury bond market. By monitoring changes in interest rates and the resulting impact on yields and prices, traders can make informed decisions about when to buy or sell bonds. In summary, the relationship between yields, prices, and interest rates is crucial to understanding the Treasury bond market. Traders must be aware of how changes in interest rates can impact the price and yield of bonds, and use this knowledge to make informed trading decisions. In the Treasury Bond Basis, Galen Burghardt discusses several trading strategies used in the Treasury bond market, including basis trading, cash and carry trading, and the repo market. Basis trading is a strategy that involves taking advantage of price discrepancies between cash bonds and futures contracts. This strategy involves buying a cash bond and selling a futures contract on the same bond, with the goal of profiting from the difference between the two prices. Basis trading is commonly used by hedge funds and proprietary trading firms. Cash and carry trading is another strategy used in the Treasury bond market. This strategy involves buying a cash bond and financing the purchase with a short position in the corresponding futures contract. The goal of this strategy is to earn a profit by selling the futures contract at a higher price than the cash bond, while earning interest income on the cash bond. This strategy is often used by institutional investors, such as banks and insurance companies. The repo market is another important aspect of the Treasury bond market. The repo market is a form of short-term borrowing that involves the sale of a security, such as a Treasury bond, with an agreement to repurchase it at a later date. This market is an essential source of funding for many market participants, including banks and hedge funds. The repo rate, which is the interest rate at which Treasury bonds are borrowed in the repo market, is closely watched by traders and investors as an indicator of market liquidity and the supply and demand of Treasury bonds. Overall, understanding these trading strategies is essential for successful trading in the Treasury bond market. By using these strategies, traders can profit from market inefficiencies and market movements. However, traders must also be aware of the risks associated with these strategies, including interest rate risk, liquidity risk, and credit risk. By understanding the risks and rewards of these strategies, traders can make informed decisions about how to incorporate them into their trading strategies. In the Treasury Bond Basis, Galen Burghardt discusses the role of the repo market in the Treasury bond market. The repo market is a form of short-term borrowing that involves the sale of a security, such as a Treasury bond, with an agreement to repurchase it at a later date. This market is an essential source of funding for many market participants, including banks and hedge funds. In the repo market, Treasury bonds are used as collateral for short-term loans. The repo rate, which is the interest rate at which Treasury bonds are borrowed in the repo market, is closely watched by traders and investors as an indicator of market liquidity and the supply and demand of Treasury bonds. The repo market plays a crucial role in the Treasury bond market because it provides liquidity and flexibility to market participants. By using Treasury bonds as collateral, participants can access short-term financing at a relatively low cost. This can help them to manage their cash flow and liquidity needs, and to take advantage of investment opportunities as they arise. One important aspect of the repo market is the use of repurchase agreements, or repos, to finance Treasury bond positions. In a repo, the borrower sells Treasury bonds to the lender and agrees to buy them back at a later date at a higher price. This transaction is essentially a collateralized loan, with the Treasury bonds serving as collateral for the loan. Another important aspect of the repo market is the role of the Federal Reserve. The Fed uses the repo market to implement monetary policy by buying and selling Treasury bonds to inject or withdraw liquidity from the market. This can help to stabilize short-term interest rates and maintain the smooth functioning of the financial markets. Overall, the repo market is an essential aspect of the Treasury bond market, providing liquidity and flexibility to market participants. By using Treasury bonds as collateral for short-term borrowing, market participants can manage their cash flow and liquidity needs, and take advantage of investment opportunities. By understanding the role of the repo market, traders and investors can make informed decisions about how to incorporate this market into their trading strategies. In the Treasury Bond Basis, Galen Burghardt discusses the various economic and political factors that can affect the Treasury bond market. One important factor that can affect the Treasury bond market is inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and it can have a significant impact on the bond market. If inflation is rising, investors may demand higher yields on Treasury bonds to compensate for the decrease in purchasing power of the bond's future cash flows. Conversely, if inflation is falling, investors may be willing to accept lower yields on Treasury bonds, as their future cash flows will have more purchasing power. Monetary policy is another important factor that can affect the Treasury bond market. Monetary policy is the process by which the Federal Reserve sets the interest rate that banks charge each other for overnight loans. Changes in monetary policy can have a significant impact on the Treasury bond market, as they can influence the level of interest rates and the overall economic outlook. Geopolitical events can also impact the Treasury bond market. Events such as wars, political instability, and natural disasters can create uncertainty in the market, which can lead investors to seek safe haven assets such as Treasury bonds. This can cause the price of Treasury bonds to increase, leading to lower yields. Another important factor that can impact the Treasury bond market is the yield curve. The yield curve is a graph that shows the yields of Treasury bonds with different maturities. A normal yield curve slopes upward, with longer-term bonds having higher yields than shorter-term bonds. An inverted yield curve, on the other hand, slopes downward, with shorter-term bonds having higher yields than longer-term bonds. An inverted yield curve is often seen as a warning sign of an impending recession. Overall, the Treasury bond market is affected by a wide range of economic and political factors, including inflation, monetary policy, geopolitical events, and the yield curve. By monitoring these factors and understanding their impact on the market, traders and investors can make informed decisions about how to position themselves in the Treasury bond market. In the Treasury Bond Basis, Galen Burghardt discusses the importance of understanding the delivery options available for Treasury bond futures contracts. Delivery options are an important aspect of Treasury bond futures contracts, as they determine the specific Treasury bond that can be delivered to satisfy the contract. The delivery options for Treasury bond futures contracts are designed to offer flexibility to market participants, allowing them to choose the most efficient delivery instrument for their needs. There are several delivery options available for Treasury bond futures contracts, including the cheapest to deliver option, the wild card option, and the timing option. The cheapest to deliver option is the Treasury bond that is the least expensive to deliver on the settlement date. This option is the most commonly used delivery option, as it provides market participants with the ability to choose the most efficient delivery instrument based on market conditions. The wild card option is another delivery option available for Treasury bond futures contracts. This option allows the delivery of any eligible Treasury bond that meets the specified criteria, rather than requiring delivery of a specific bond. This option can be useful in situations where the cheapest to deliver bond is not available, or where market conditions make the use of the wild card option more efficient. The timing option is a delivery option that allows market participants to choose the delivery month for their Treasury bond futures contract. This option can be useful for market participants who want to hedge their exposure to interest rate risk over a specific period of time. Understanding the delivery options available for Treasury bond futures contracts is essential for successful trading in the Treasury bond market. By understanding the differences between the delivery options and their impact on the market, traders and investors can make informed decisions about which delivery option to use for their specific needs. In summary, the delivery options available for Treasury bond futures contracts offer flexibility and efficiency to market participants. By understanding the differences between the delivery options and their impact on the market, traders and investors can make informed decisions about how to use these options to manage their exposure to interest rate risk. In the Treasury Bond Basis, Galen Burghardt discusses the importance of understanding the relationship between Treasury bonds and other fixed-income securities. Treasury bonds are often used as a benchmark for other fixed-income securities, as they are considered one of the safest investments in the world. The yield on Treasury bonds can influence the interest rates on other debt instruments, such as corporate bonds and mortgage-backed securities. As a result, changes in the Treasury bond market can have a significant impact on the entire fixed-income market. One important aspect of the relationship between Treasury bonds and other fixed-income securities is the concept of spread trading. Spread trading involves taking positions in two related securities with the goal of profiting from the difference in their prices or yields. One common form of spread trading is the Treasury bond spread trade, which involves taking positions in Treasury bonds and other fixed-income securities with similar risk characteristics. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.